to another party. What do we mean? That means, for example, if I give you a loan of like 10 million, to me, that loan, if I give you a loan, to me, it's an asset, but to you, it's a liability. Now, that's what we call a financial instrument. If the company issues shares and you buy the shares, if you buy the share, to it becomes an asset, to the company becomes a liability. So now that's what we call financial instrument. So under the two, we have financial asset, financial liability. Now let's focus on financial asset. And what are financial assets? I said that financial assets, they are just financial investment, and they are broadly categorized into four. But I want to look at the two. Number one, we have what we call financial asset at fair value. I'm trying to categorize the financial asset. Majorly there are four, but I want to classify them into two. We have financial asset at fair value. Now, financial asset at fair value, number one, they are short-term financial investment. That means if they are short-term, you take it to the part of current asset. I repeat again, financial asset at fair value, they are short-term investment. Hence, it should be recognized under the current asset. Then they are measured or valued at fair value. And fair value simply means the market value. Fair value is the market value. That's number one. Let's go to number two. We have another financial asset known as available for sale financial asset. Available for sale financial asset. Now, AFS, this one is a long-term investment. Long-term investment. If it's a long-term investment, that means we'll be recognizing it as part of non-current asset. I repeat again. Available for sale, they are long-term investment. Hence, they should be recognized under non-current asset. Then they will be measured either at cost, or what you call the amortized cost, or at fair value. So you can use the two valuation model, either the cost or the fair value. Now, let me go back again. We have said that we have financial asset at fair value and we have available for sale. Financial asset at fair value, they are short-term. Available for sale, long-term. Financial asset at fair value, they are current asset, but available for sale, they are long-term asset or non-current asset. Another difference is that for financial asset at fair value, they are recognized or measured at fair value. That's the market value. But for available for sale, they will be recognized or measured or valued either at cost or at fair value. Good. Another thing, let's look at what we call deferred tax. Deferred tax. Now, deferred tax, in another term, we have what we call the current tax and we have the deferred tax. So what do you think is the deferred tax? Deferred, or we can say deferred payment. Now, deferred tax is the tax payable in the future. That's what we call deferred tax liability. Deferred tax, tax that you'll pay in the future. Also, sometimes you may overpay your taxes. So that means you have something you recover in the future. That's what we call deferred tax asset. So deferred tax in layman's language just means the tax payable in the future, which arises as a result of what we call temporary difference. What are those temporary differences? Now, the temporary difference are what we call the difference between the carrying amount and the tax base. Now, for those who have done taxation, how you account for profit as an accountant is totally different from how a revenue authority will account. You see, for the tax aspect, we have what we call allowable, disallowable expenses. But for accountants, an expense is an expense, an income is an income. Now, the difference between the two perspectives is what we call the temporary difference. And the temporary difference is what gives rise to deferred tax. Now, this is what I mean. Assuming you have a land that you bought it like 2 years ago at 100 million as a corporation. So that means the tax base is 100. Then at the end of the year, you revalue that asset upward, maybe to 120. The cost was 100, but by the end of the year, it's 120. So that means we have a gain, yangapi, of 20 million. Now remember KRI, they know every gain should be taxed. So this 20, you subject to tax of 30%. So that means 30% of this gain of 20, that's 6. But now remember one thing. Yeah, that's tax of 6. But you have not sold the asset at umepata pesa. So that means that tax will have to be carried forward. So that's what we call deferred tax. You are not paying now, you'll pay in the future. Another thing you need to know that increase in deferred tax liability. Remember, deferred tax is a liability. I usually do what we call provisions. If a deferred provision increases, that one becomes an expense. Like for example, if you're supposed to pay a deferred tax of 20, but next year increase to 30, you can see the movement from 20 to 30. That increase by 10 becomes an expense. You have to pay more. But if deferred tax reduces, that means the reduction in deferred tax, that one becomes an income. I repeat again, if deferred tax provision reduces, that one becomes an income. If deferred tax expense increases, that one becomes an expense. So you need to get the two. I think you need to get there. I think with that one we okay. Then another thing we need to look is how to recognition of ordinary shares. Recognition of ordinary share. Now, how do we measure ordinary shares? Now, ordinary shares should be recognized at par value. Ordinary share capital should be recognized at par value with the balance taken to the share premium. This is what I mean. Let's go back to the whiteboard. Go to the whiteboard. Now, this is what I mean. Assuming you had 100 shares and you had bought each at 10 shillings. So that means you have equity worth 1,000. You had 100 shares in a certain company and you bought each of the par value of 10. So that means your worth is 1,000. Now, assuming after 2 years, you still have the same number of shares, 100 shares. But at now, remember the market price usually do keep on changing. But for now, you get that the current price, the market price is 15 shillings. So that means your current net worth equity is 1,500. How do you recognize this one to the financial statement? What do you take to the ordinary share capital? What do you take to the share premium? We have said that to the ordinary share capital, recognize them at par value. That means you'll take 100 shares, the par value, the original, it was 100, it was 10. That means the ordinary share capital, it will be 1,000. Then to the share premium, remember premium is a gain on the share. You have 100 shares, the price has moved from 10 shillings to 5. That means there is a gain of 5. That one you take it to the share premium. However, you multiply by, you have 100 shares and each has gained by 5. So you have 500. So that's how you recognize. To the ordinary share capital, you take 100. To the share premium, you take 500. If you mess, you just take the whole 1,500 to the ordinary share capital. That thing is wrong. So remember, for financial reporting, we need to follow the standards. We have the AS, we have the IFRS. So that's another thing you need to consider, recognition of that. Another thing you need to know is how do we recognize tax expense? Now, the tax expense is made up of 2 components. Number 1, we have what we call the current tax, and then we have what we call deferred tax. So the current tax, you're just taking the current, now the current tax is just tax based on the profit for the year. That's simply, if you made a profit of 10 million, you just take 30% of that. That's what we call the current tax. Deferred tax, we have said, is just the movement, tax payable in the future. Tumesema, if a deferred tax increases, that one becomes an expense. Kwa hivyo, you add. That means you have to pay more taxes. If deferred tax reduces, it becomes an income. That means if it reduces, you deduct. You take the current tax minus the provision. That means you'll pay less. So to the tax expense, we have the current tax, we have deferred tax. Another thing you need to consider is that PPE, what we call the plant, property, and equipment, when preparing the published financial statement, PPE should be recognized as a single figure. What do we mean? Assuming you have, assuming you had land, you had plant, you have fixtures, you had fittings, to the balance sheet, you don't show them separately. No, we have said that publish something that is summary. It's just a summary. So if you are doing, you have those other items, you have to go to the workings, work out for PPE. You bring the land, you bring the building, furniture, you put them together, you work out them together. To the balance sheet, you take them as one figure. So it's another thing you need to note on that. So that means to the statement of financial position, PPE should be recognized as a single figure. So another thing I want you to note, it's all about recognition. What do we take to the income statement? What do we take to the balance sheet? So under the expenses to the income statement, expenses will be classified into 4 classes. Number 1, it's either cost of sale, or it's either an admin expense or selling and distribution expense or finance or interest expense. I repeat again. To the income statement, expenses will be classified them into 4. It's either cost of sale or admin expenses, selling and distribution, and finance. Now, finance will be dealing with the interest. So, assuming we have depreciation, we have salaries and wages, we have staff costs, there is nothing like that to the state when you're preparing the published financial statement. You have to work those costs separately and you bring them as a summary. It's either cost of sale, admin expenses, selling and distribution, or finance cost. Good. Then another thing you need to note, we have what we call other incomes. We have what we call other comprehensive income. Other incomes, other comprehensive income. What's the difference? Now, other incomes is income which is eligible to be distributed to the shareholders as part of dividend. It's their wealth. But what you take to other comprehensive income definitely will go to the statement of changes in equity as part of reserves. So you need to note that what do we take to the income, to other income, what do we take to other comprehensive income? All items valued at fair value. I repeat again. Items valued at fair value, their revaluation changes should be recognized under other incomes. I repeat again. Revaluation changes for the items valued at fair value. Fair value is the market value. Either you may gain or you may lose. Those changes should be taken to other income, either as a revaluation gain or revaluation loss to other incomes. Now, other incomes ni kule juu, just below the gross profit. Number 2, revaluation changes for PPE, that's plant, property, and equipment, and available for sale, AFS, should be reported under other comprehensive income. I repeat again. Revaluation changes for item valued at fair value, that's the market value. Their changes should be reported to other incomes. Then, revaluation changes for PPE and available for sale. Remember, we have said that available for sale, they are long-term investment, therefore they are non-current asset. Their revaluation changes for both available for sale and PPE should be recognized under other comprehensive income. Kule chini. Now, other comprehensive incomes comes immediately after the profit after tax. And what you take to the other comprehensive income will definitely go to the statement of changes in equity as reserves. That's all. Hakuna kitu ingine. Take out your past paper. Take out your past paper now. So actually, I'll send this. Everything I have said, I have summarized them somewhere. So I'll give you that. Don't you worry. I'll share with you. Let's open a question. November 2016. November 2016, question 2. November 2016, question 2. And I'm hoping you're having your past paper with you. Hoping all of us were there. November 2016. So you're told that the following trial balance was extracted from the book of Peak Limited as of that 1st October 2016. So we have land, we have building, brand, purchases, distribution expenses, admin expenses, loan interest paid, lease plant rental. Also you have inventory, that's opening, account receivable, long-term investments. So you have long-term investment, those are the available for sale. If they are short-term, those are financial assets at fair value. Then we have revenue, ordinary share capital, income from investment, retained earnings, 8% debentures, dividend paid, account payable, cash in hand, deferred tax, bank overdraft, then accumulated depreciation for both building and plant. Now let's go to the additional information. Number one, the 8% debenture was issued on 1st January 2016. Interest payable 6 months in arrears. We'll come to adjust that. Number two. Before I go to number two, I have seen someone asking a question. If the share price decreases, so we have no situation where the share price can go below the par value. The share price can go below the market value, but cannot go below the par value. If it goes below the par value, that one you need what we call reconstruction. That one means you have to petition for the court. So that means the share price cannot decrease beyond the par value, but can decrease below the market price. So let's go to additional information number two. Inventory was valued as 259.2 million as at that 1st October 2016. So that's the closing stock. Number three, on 1st November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which is payable in advance with effect from 1st November 2015, was 132 million. The fair value of the plant is 552 million, and the implicit interest rate is 10% per annum. Number four, plant is depreciated at the rate of 15% per annum using reducing balance method. That means based on the net book value. Depreciation expense is to be included under cost of sales in the income statement. However, you have told where to take that. Then number five, land and building were revalued on 1st November 2015. Now 1st November, that means at the beginning of the year, at 600 million and 1050 million respectively. After revaluation, the building was estimated to have a useful life of that 5 years with nil book value at the end of the economic lives. Then number six, the corporate tax for the year ended that 1st October 2016 was estimated to be 169.8. The deferred tax provision as at that 1st October 2016 was increased to 81.6. Required the income statement for Peak Limited in a format suitable for publication. That's published financial statement. Number B, statement of changes in equity. Number C, statement of financial position. So now we need to adjust now. We want to adjust every note. So we are doing that November 2016. We are doing question number 2. So let's start with additional information number 1. Number one, we are told that, if I may take you back again, that the 8% debenture was issued on 1st January 2016, 1st January, and the year ends on that 1st October. So that means the debenture have been in our company for 10 months. So this I'll get the interest. You take 8% of the debenture. Let's go to the balance sheet. We see how much was the debentures. The 8% debenture was 300. I'm hoping you are having your past paper with you. It's 300. so that you can get, remember 8% is per annum, times 300, you get the interest per year. But remember, we issued it on 1st January 2016, and the year ends on October. So that means it's 10 months. So you multiply by 10, you divide by 12. And if you do like that, you'll get 20. So this 20 is what you take to the income statement. Now, I want us to go back to the trial balance. There is somewhere we have given the interest, loan interest paid. Loan interest paid. Yeah, we have somewhere loan interest paid. And we have loan interest paid of 8. So that means you are supposed to pay 20, but during the year you paid 8. So that means we paid 12. Yeah, the interest paid was 12, sorry. The interest paid was 12. So that means you have balance of 8. So this one you take to the balance sheet as part of current liability. The 20, you take it to the income statement, the whole amount of 20. Remember, you account using the accrual basis. The 20, you take it to the income statement. Then we paid, of the 20, we only paid 12. So that means the 8 is you take to the balance sheet as part of current liability. Let's go to additional information number 2. Additional information number 2. Number 2, we are told that inventory was valued at 259 million as at that 1st October 2016. That's the closing stock. If you are given the closing stock and you are told the closing stock was 259.2, if you're given the closing stock, that means you are not given the cost of sales. If you're given the closing stock, you are not given the cost of sales. And how do we get the cost of sales? Cost of sale is opening stock, you add the purchases minus closing stock. That means, let's go back. The opening stock from the trial balance, inventory, 1st November 2015, it was 226.8. 226.8. Then you add the purchases. You go back to your past paper. The amount of purchases was 469.2. Then you deduct the closing stock, and you are given the closing stock was 259. 259.2. If you compute that, you get the cost of sale as 436.8. That's what I can get. Let me repeat again. If you are given the closing stock and the additional information, you are given that one so that you can be able to determine the cost of sale. And the cost of sale is opening stock plus purchases minus the closing stock. Let's go to note number 3. Note number 3. You are told that, number 3, on 1st November 2015, that's at the beginning of the year, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st November 2015, was 132. So that means it's payable in advance. So this can either be paid in advance, like rent, or it can be paid in arrears. So you have to differentiate the two. When it's payable in advance, when it's payable in arrears. So in this case, it's payable in advance. So whenever you see leases, you prepare what you call amortization schedule. Amortization schedule. And in this case, you have to bear in your mind that in this case, you are paying them in advance. How do we account when you are paying leases in advance? Let's continue with the question. The fair value of the plant is 552 million and the implicit interest rate is 10% per annum. Let me give you 3 seconds. Go through that number 3 again, about leases. Good. Now let's continue. Now let's be here. Whenever you're paying your leases in arrears, now one thing you need to note, when you are preparing published financial statement, you only prepare the leases for only 2 years. So that means for the period, you only show just 2 years. Remember, you're told that the lease is for 5 years. You know about the 5, I'll show where to use the 5. But when preparing the financial statement, only prepare for 2 years. So you take the balance brought down. Then in this case, we are paying in advance. So that means you start with a payment. After you pay, now you can determine the balance due. To get the balance due, now you can determine the interest for the period. To determine the interest, now determine the principal. And now finally you can get the balance carried down. We are told that this plant has a fair value of 552. And the payment, which is payable in advance, it's 132. That means it's 552. You immediately pay, because we're paying in advance, 132. That means you'll have a balance of 420. That's what you'll take home. Then this 20 is what you'll pay the interest based on that. And the interest was 10%. If you take 10% of 420, it's 42. Now let's get the principal. How do we get the principal? How do we get the principal? Remember, you already paid them 132. If you pay them 132, they knew the interest was inside. So you take 132. First of all, they eliminate their interest. So it's 132. You raise the interest of 42. So that means the principal is 90. If you pay 90, that means the balance carried down. Remember, the balance was 552. You deduct the principal of 90. That means the balance carried down will be 462. You take 552, you raise the principal. Now the balance carried down becomes the opening balance. So it's 462. The payment does not change. So you pay them 132. That means 462, you minus 132. How much will you get? So in that case, you'll get 330. Then interest is 10% of 330. Take 10% of 330, which is 33. Now let's get the principal. You paid them 132. You eliminate the interest, which is inside. So that means you get principal is 99. 132 minus 33. To get the balance carried down, you take the balance brought down at the beginning of the year was 462. You deduct the principal. So it's 462 minus 99, and you get 363. Now, what do we take to the income statement? What do we take to the balance sheet? Kindly be here. To the income statement, just focus on the first year. What we take to the balance sheet, those are the liability, focus on the second year. I repeat again. To the income statement, you focus on the first year. This is the year we are working on it. I'd usually take 2 items to the income statement. Number 1 is the interest. And the interest you only take for year 1. For year 1, this year we are supposed to pay an interest of 42. That's what you go to the income statement. Also, we have depreciation